In this presentation, we will take a look at multiple choice questions related to common managerial accounting decisions and scenarios, going through those questions and then practicing test taking skills with them. First question, paid $300,000 5 years ago for a machine that has no salvage value and is being depreciated at a rate of $5,000 per year. The company is considering using the machine in a new project. The project will have revenues of $30,000 per year and annual cash expenses of $21,000. In analyzing the new project, the $300,000 is either A, lost cost, B, opportunity cost, C, sunk cost, D, fixed cost, or E, relevant cost. Okay, let's go through this again. Note that it's important to look at the answers, and we might, when you see a long type of question like this, you might want to go directly to the last sentence. Notice what the last sentence says first, and then go through the question, because you can see it's going to be a numbers type question. You look in the answers, and there's no numbers in the answers. That's kind of funny. And then you might say, well, what are they looking for here? Let's read the final sentence first, the what do we want sentence. So we're going to go down here. It says, analyzing the new project, the $300,000 is what? So I'm going to go right up into the text. I'm going to say, here's the $300,000. That's what they're asking about. The reason this is important is because a lot of times, one multiple choice question, one set of numbers will be used for multiple questions, or they might pick one question that out of a test bank that was used for multiple questions. So what you want to do is zero in on what it might be a really easy question. This question is fairly easy considering all the numbers that are involved, and there's no calculations involved in this, even though there's a lot of numbers in it. Okay, so let's go through it again. Paid $300,000 5 years ago for a machine that has no salvage value and is being depreciated at the rate of $5,000. Now, note that the company is considering using the machine in a new project. The project will have revenues of $30,000. Note that once you see this kind of thing, the question, of course, is going to be from a managerial accounting topic, should they take on the new project or not? That's what you're expecting if you were to read this type of question. And when you look at the $300,000 in relation to this type of question, the first thing that should pop into your mind is the $300,000 happened in the past. So we're not going to use it for the calculation of whether or not we should do something at this point going forward. The past money's already gone. It's already spent. The question is, what should we do at this point forward? So in that sense, the $300,000 is not going to be included in our calculation. The term that correlates to that, what is that going to be? A lost cost? Sounds appropriate somewhat. Opportunity cost, that would be the cost of a second option. A sunk cost, so that sounds familiar. A fixed cost. We're not really talking about a fixed cost here. It's fixed versus variable, usually you would see here. This is kind of fixed, but a relevant cost. And that's not it because it's irrelevant. It's not relevant. So it's not going to be a relevant cost. And the term we're looking for is, of course, the sunk cost. So, and this is always going to be present in these type of questions. If you've got the machine, this is what we paid for the machine a while ago. Now we're making a decision now. Does the fact that we paid for it a while ago and we can't change the fact that we paid for it a while ago affect the decision we made now, even if it was a large dollar amount, $300,000? No, it doesn't. The question is what we can do now with what we have now. Moving forward, any cost in the past is sunk, not a factor within the decision-making process here going forward. Next question. Added cost only if a particular course of action is pursued, either A, opportunity cost, B, out-of-pocket cost, C, discount cost, D, added cost, or E, incremental cost. Let's go through this again using the process of elimination. Added cost only if a particular course of action is pursued. So 1A, opportunity cost. That seems like it could be appropriate. B says out-of-pocket cost. Again, that sounds like it could be relevant. C says discount cost. That doesn't seem like something we're dealing with right here. And D says added cost. And again, that sounds like it could possibly be appropriate. And E says incremental cost. That's another term that should sound somewhat familiar. So let's go through this again. Added cost only if a particular course of action is pursued. Now, all of these sound like they could possibly work in here. So we're looking almost for the best answer rather than an answer that we could argue should be correct, right? So we have the first one is opportunity cost. That's going to be a cost of the choice we did not choose. So we could say, well, opportunity cost is a cost of an action we didn't choose, so we could argue for that, but I don't think it's the best fit given the other options here. Out-of-pocket cost is a future outlay given a particular course of action. Again, an out-of-pocket cost might change depending on the different choices we have, but I don't think that's going to be the best option given our other two. Added costs, that's not really a term here. The one we're looking for is the incremental cost. So the incremental cost is, pretty much by definition, added cost only if a particular course of action is pursued. So when we say it's an incremental cost, we're basically saying within the text, hey, this is the cost of this particular action, the cost that will change, the cost that will differ between decision makings, the relevant cost. So that's what so the final answer, E. Added cost only if a particular course of action is pursued, E. Incremental cost.